anybody is not familiar, my name is Dan Weiskopf. And I'm ETF professor, also lead portfolio manager lead ETF strategist for the ETF think tank, and also co-portfolio manager of Block. Most importantly, I'm on the investment committee at Title Financial. And Title loves to launch ETFs, so if anybody has any great ideas, give us a shout. So, David, you're up next, my friend.
How's it going, everyone? David Dziekanski here. I'll keep it short and sweet. Portfolio manager within the Title Financial Group. Really excited to have Jeff Macke on the show today, CNBC's Fast Money, and talk all things stock specific, specifically focusing around the consumer. Anyone watching this, feel free in the chat if you have stocks later on that you want us to touch on or specific questions. Drop us a note. This is going to be a whole lot of fun. Jeff, if you wouldn't mind, introduce yourself and tell us everything that's going on in the world today. So,
absolutely. I'm Jeff Macke, as you mentioned, former CNBC personality, kind of been a personality over half my life now at this point, been writing online, talking about stocks for 25, 30 years. I'm a partner of Wall Street Beat's online media platform where we talk about investing every morning. You can get a discount. You can enter in lead lag 25 right now this week, and just hear me and Harold Greenberg, other financial professionals, just exchange ideas and kind of try to forge good thoughts out of the heat of nice debate. And that's kind of the best way to do it, in my experience. So that's what I'm doing now, and that's what I'm here to do tonight.
we were just talking pre-show about Netflix numbers, and I think that kind of puts the entire earnings season into picture very well. Pretty strong top line numbers, very strong numbers, and still a disappointing result. So what happened with Netflix today? Why was it a yawn? Why is the stock down a little bit? Why is that okay, given the lofty expectations? And what does that say about like this entire earnings season?
A yawn as a reaction to those numbers, it's actually pretty good. You know, I mean, I've been through a few cycles, and it used to be, and in more bullish times, a beat like this, people would have bought it anyway. You know, they just beat by some 20%, give or take, on earnings, and the stock is lower because of guidance. Now, they did say they're not going to count ARPU or sub numbers anymore, which takes two metrics that people would like to use to actually value the company out of play next year, and they're probably not hiding those numbers because they expect them to get a lot better. So, you know, you have a slowing growth company that won the streaming wars. What is winning the streaming wars worth? I don't know, but that Netflix is just way too high from where it was relative to a year ago for people to pay more for it now. And so what are they going to believe? They're going to believe the cautious guidance. I saw that a lot. I listened to just tons of conference calls, particularly in the consumer space. And what you saw in the reports that just finished up in March, what a great Q4, kind of a mediocre first quarter, and guidance was really back-end weighted. So we're reading for a good Christmas. Yeah, with the economy where it is right now, the Fed's no longer on my side. The price of anything that you can eat, live in, or wear on your body seems to be going higher. You don't have to be super rich to get a little sticker shock. And so people are just pulling it in a little bit. Netflix didn't have anywhere to go. Why is 3% down a good reaction? Because if they would have missed last quarter and came out with the same guidance, it would be down 15, 20%. It's an exceptional company, a really good company. You're not going to pay a premium for really much of anything right now. And so this is a fine reaction. If you can figure out how to trade down 3% and just kind of selling the crap out of volatility and rolling the dice, let me know. I would rather be on the sidelines. I'm long a little Netflix, a little less than I was before, and I'm really not that stressed one way or the other, which is going to be the recurring theme you get in terms of ideas right now. This is a nice time. I'm a big believer in kind of sell until you can sleep. Have enough cash on hand that I'm not going to be up all night either way, no matter what Netflix says or whatever the reaction is, because I'm taking some gains and just chilled. The last 6 months, we were on a heater going into March. We were on a heater because there were all kinds of assumptions about what the Fed was going to do, and 6 cuts and all this business. That's clearly not going to happen. The economy doesn't seem to be really falling out of bed either, so it's not a great time to be bearish. And, you can overtrade this thing and overthink it all you want. I've never made money doing it, so it's better to just relax a little bit.
So Jeff, I know you may not be focused on the financials, but financials fund the consumer. What have the reports from JP Morgan and BofA told you about how the consumer's doing?
It's you get a lot of kind of the low-end consumer. They're feeling a little pinched. They love to say things in kind of the abstract without a ton of firm numbers on what that looks like exactly. But there's not just the sense that the consumer has eased back on spending, but there's always that impending sense of the sort of Damocles is coming down, and the consumer's going to hit the wall because they're over-levered and their credit card debts are so terrible. And everyone else is stupid except for the way those individuals personally run their finances, and the world's about to hit the wall. In my experience, that hasn't been happening. We're still seeing, whatever the banks say anecdotally, it's if they're paying $1,500 starter to get into Taylor Swift, the economy can't be all that terrible. If they're then going out to the theaters to watch that movie, it can't be all that bad. Is it great on the low end? Nope. It's really bad. I don't know about you guys. I live in California, where it's kind of the Mendoza line of consumer concerns is whether it costs me $100 or more to fill up my car. When that happens, you notice it. It doesn't matter what your economic condition is. It's like, wow, triple digits to fill up the mobile. That's not great. It costs me more to eat now. That's not great. The consumer is choosier than they were before. You see that when you talk to the individual companies. You see hints of it when you hear it from the banks in kind of a more sweeping way about cautious consumers. What they really mean is, the super discretionary items folks are pulling back on, but there is no, you're still seeing things like, it was just the biggest WrestleMania of all time. Does that matter? Nope. Does everyone like wrestling? Absolutely not. Are you kidding me? It's a carnival show. But there is nothing more discretionary than buying a WrestleMania t-shirt, than tuning in for a UFC fight. You saw huge UFC numbers as well. These are discretionary consumer reads and not necessarily the high end. And I would take them as a tell. I'll take Costco's numbers as a tell of what the consumer is doing more than I will sort of the thoughts of Brian Moynihan. Respect him though I do. I like the Costco report a little more because they're telling me specifically what people spent in March, and it was better than inflation. That company, another one, a fairly expensive stock, been on a heater, but the sky's not falling. And if it's not falling there, it's hard to make the case that it's falling all over the rest of the world.
I would argue a 45 PE becomes pretty stretched for a company in that category, even of that caliber. But back to interest rates, as you alluded to, we went into the year expecting potentially 7 rate cuts. We have a number of Fed meetings left in the year, but there's some expectations that there's really only 2 that could potentially have cuts, and that's July and December. 1, just because no one expects cuts in any time in the near future, and 2, expectations of Fed cuts being spaced out from political events. So that leaves like 2 periods, maybe 2 25 basis point cuts. What is like your expectation on how interest rates are actually affecting the economy from like slowing it down or speeding up? Because there's more and more consensus on the viewpoint that interest rates are actually not slowing down this economy because of the haves and have-nots, right? The ones with assets, the increased yield, the value, the increased value of a 30-year mortgage. There's a big difference between the average and the median consumer. So how does that play out, right? Like, is this really going to slow us down, or is QT the only thing that slows down this economy? What are your thoughts on interest rates actually being a good tool when most of the debt is on the government's balance sheet versus like the corporate balance sheet?
I think it's really the direction and the perception of what the Fed's doing as much as the actual rates themselves. To the unifying theory of investing in stocks in this type of environment, the Fed isn't on my side. And so to return to Costco at 45 times earnings, well, the Fed's not on my side. I can't even come up with a thesis for a company that's going to grow a little better than GDP on the top and bottom lines. Even with the club, even as good as they're doing, it's you need that as a tailwind. And so as long as those expectations are changing, that's what I care about. I care about the idea that we've gone from what we thought would be an environment of multiple cuts of we beat inflation. Holy crap! Look at it's let's have a parade. It's VE day. We've got it's freaking rain the confetti and the ticker tape all over the place. Well, we don't have kind of that environment anymore. And so again, for my perspective, what I care about on the consumer side of things is that everyone's a little rate sensitive when it comes to the direction of prices that they're paying and the stuff they can't ignore. And that affects obviously on the lower end consumer where they're more just, they're up against it a little more. That's where we're seeing the first signs of strain, which makes sense, but you're also seeing the high end watch market kind of fall apart a little bit. You're seeing some pressures, among rich people as well. everyone sweats it. Rich people didn't get rich because they completely ignore the cost of capital. That's not how, in fact, it works. They feel a little more flush sometimes than others. And so, you're seeing some evidence that they're cutting back on the marginal spending that they might otherwise do, which, in my world, in the consumer brand space, how that plays out is you'll have companies in the same industry where one will just hit the wall. You see the difference between the haves and have-nots from the companies themselves, and it doesn't necessarily matter if they're high or low end. It's just when they fall out of fashion, you have this consumer now that's either paying full price or no price at all. And discounts just don't seem to matter. And that's been kind of the case ever since we started COVID now, where for years, give a company that's another sort of fallen angel, Lululemon, they haven't had a discount in ages. Williams-Sonoma hasn't had to mark anything down in their stores for the last 2 years. Is that sustainable? No. But I mean, if you're competing with them, if you're the Gap, for instance, you're sitting next to a Lululemon, you've got your entire store marked off 25%. If someone just walks in, you get 40% if you buy more than $50, all these crazy discounts, and the store's empty. You could play golf in a typical Gap store and not risk hitting anyone with your ball. And the Lululemon is still doing gangbusters business. Now, does that make it a stock you can own? No, because we returned to really expensive stock, it on a heater. There's no place for them to go. And that is kind of how that's what makes me cautious in this environment. When the good companies can't report numbers that are good enough, when Netflix can beat by 75 cents and basically declare victory on the streaming wars, and the stock is down 3%, well, they effectively just blew out estimates and it's flat. That's your risk reward. Down 20% versus flat.
So I was talking to a 78-year-old guy, and he was really proud of how he built his portfolio from 20, 25 years ago. Right? And of course, that portfolio included Apple. And Apple is a consumer stock, huge winner. Where do you stand on Apple? Because I would argue Apple is technology, consumer brand, discretionary, maybe a bond even for some people, right? I mean, it's not paying a big dividend, but it's got that balance sheet. What are your thoughts around Apple? Because I think part of the thing about Apple is nobody ever wants to sell it because it just keeps climbing higher for not always great reasons.
It was going higher, but now we've got kind of a Microsoft in 99 situation where you got the feds crawling down their gullet right at the same time that they're actually kind of losing a little bit of share. You're seeing like some iPhone data that isn't quite as gangbusters as we're used to. Does that make Apple the scum of the earth and a terrible company? It's like a bond. I mean, if they closed Apple and they tried to hide, they would still be making $1 billion a day just from people paying for stuff. I mean, the money inflow at that place is just spectacular. And Amazon's another one where you see these guys, they're taking swings that 20 years ago, 10 years ago, 15 years ago, Prime was seen as a big risk for Amazon. At this point, it's just the absolute money spigot that fuels anything they want to do. And so they wanted to do Prime Video. They spent so much money on that. The return's been for garbage. But, it's just become a monolith. Apple, the stock is actually down quite a bit. It's been flagging. It's down below. I think it's 50 for the first time in forever. You never want to buy them when they're lower. And, after the run they've had and with the challenges they're facing, I'm not sure you do now. But, man, that has been the wealth career of all time. And everyone likes to think they wouldn't sell it. I'm old enough to remember the first time Amazon was a bubble stock and then hit the wall for about 10, 15 years. It went down some 80%. I've never met the guy who held it all the way through that didn't actually work at Amazon through that. So, I would guess the 78-year-old guy was smart enough to put Apple into a secret lockbox in an account that he didn't look at for a quarter of a century and turned out to be, hey, look at that, I'm worth $20 million. Nice. You're the big brand.
And his point was, my kids don't want me to sell because they want to step up, cost basis, right? And I think that makes sense. My concern is, both for him as well as his kids, is what happens. Who's the next buyer for the Apple, stock, right? It's so, I can't say expensive, but the value, the market cap is so big that when it starts to go down, I don't know who's going to hold it up. I mean,
who's going to step in, right?
Yeah.
And what people are willing to pay for a stock is always this intersection of sort of the narrative and then the actual financials, right? And you've just illustrated it. It's, boy, we took a lot of those would-be buyers of Apple for the year from, I think a year ago at this time, before we had the huge tech run. No one really wanted these companies. Now you've seen so many people pulled into the stocks just out of pure FOMO, just out of pure, holy crap, I'm talking to this 78-year-old guy who's made $1 zillion on Apple. I need to buy that. Anyone who was going to buy for that, they're in. They're in right now. And so you're exactly right. Who's the marginal buyer now? I'm not sure. That's a function of time and price. You need the whole Mag 7 block just needs a break. At the very least, it needs a break. If not in price, then just a little, let's call it a little timeout. Let's just gather ourselves and we'll see around November, maybe Christmas time, and we'll go shopping for some stocks. But until then, you're exactly right. What are they going to announce? It's the little virtual reality helmet thing. That was never going to be a huge product. The car thing, they actually managed to take so long creating a car that it became financially unviable to make EVs in the first place. They actually kind of were so delayed, they missed the entire cycle, moving on to other things. But the cash flows are undeniable. The size of the company, the success in the company is undeniable. It becomes just look at them type of story. And the best time to buy it's going to be the time that it's the hardest. And right now we're not there yet. We're simply not there yet on a whole fistful of really good companies. The no-brainers are just too expensive. The Costco's of the world, where you look at them and think, the subscription model, holy crap, you'll pry a Costco membership out of the cold, dead hands of most of these consumers. They absolutely are completely price insensitive. They couldn't love it more. And that's sort of the problem, is that how do you get them long? How does that become a growth story? And so you need that stock and these companies to just kind of rest a little bit, get out of the public spotlight, get people to stop talking about them day after day, and then you can start sniffing around again. When it becomes an idea that's harder to sell to people, that's when I'm interested. But otherwise, you've missed the boat. And I think right now, people who haven't been long any of these names, if you missed NVIDIA to this point, are you going to buy it because it's 10% off? Well, I'm not.
So there's a lot of great companies that are just, quite frankly, overpriced, right? You wait for a better entry point. And you mentioned just having enough cash to sleep at night, right? Be able to redeploy outside of equity allocation in your portfolio, or the percentage of allocation in equity. What are the value themes you're finding in your portfolio, and where are you seeking some areas of growth still?
Well, I'll give you an example. I've been doing a lot of work with shoes lately. The 500-pound gorilla there is going to be Nike, of course. Now, that company, they come and go, and I've seen them in slow streaks before, particularly kind of at the end of the millennium. They were on the side for a little bit, but they found their way. They're absolutely barfing up share in an unbelievable way right now. Now, where that brings us around full story is that is a tremendous opportunity for the Adidas of the world. For these other companies that may not be cheap, but you can substitute kind of the global headwinds, the economic concerns that Nike cites almost endlessly. That's not a problem for Adidas, because they're taking share from the $55 billion juggernaut in the shoe industry that is Nike, that is falling apart, and that works as a tailwind. And so you're finding a relative valuation, not necessarily being short the Nikes of the world, but just understanding that tailwind of being able to make Sambas and being able to take kind of the retro shoe share out of Nike and putting it into Adidas, that works for them. That's something that they're able to make money on. It's appealing to the retailers themselves, because like Dick's Sporting Goods, that's a company I love. 25% of that company, the revenues come from Nike. They would love that not to be the case. They would love to kind of de-lever and start diversifying their brands. All of a sudden, you have a tailwind for OnFlout. You have a tailwind for companies that aren't even remotely cheap. But man, if you're a $5 billion company and you have the chance to take a little bit of share from Nike, that's going to be all the tailwind you need. That's going to see you through a little bit of a downturn. Will it see you through China absolutely going pear-shaped? Nope. Yeah, I mean, it's if we really hit the wall in a super meaningful way, that's going to be a problem. But again, you end up with companies in the same exact industry that they're describing entirely different worlds. You see it in makeup, you see it in shoes, you see it in a lot of different spaces. And I want to be out of the stocks that are complaining about the economy, which is like complaining about the weather for retailers. The old saw is anybody complaining about the weather, just short, just sell and get the hell out of the way. If a consumer company is complaining about the economy and saying that's why they can't do business, just kind of get out of them and try to figure out either who they're competing with, or if the industry is just so warped and kind of messed up that you don't want to belong in it at all.
Before we move forward on this, my wife was really nice. She got me some Skechers. You have an opinion on Skechers? Because I got to tell you, they're super comfortable too.
I dabble with Skechers. I'm not crazy about kind of the management structure there. To be honest with you, it kind of inclines me to be long tech, but that's a great example where, Skechers, it's like, this is kind of cool. Crocs, they just brought in the guy who was the marketing director there, who drove Crocs just absolutely crazy. He went to Stanley. He created the Stanley Tumbler Cup Freeze last fall. Now he's just come back to Crocs and he's going to fix their Hey Dudes. Hey Dudes has been a lagging space for Crocs since they purchased them. Now they're boat shoes. How excited do I expect people to get? Not very, but then again, Crocs themselves are just plastic, ugly sandals that have somehow been unkillable for the last 25 years. So there's a little bit of marketing mojo there, but again, we're talking about Skechers, for whatever their management problems are, they're taking share. Crocs, for whatever they got going wrong, they're going to get more shelf space in Foot Locker than Nike's going to get on a relative basis over the next 6 months. And that matters. That matters particularly in retail, where you've seen most of the retailers take their inventories down quite a bit over the last 3 or 4 years, to the point now that the wholesale orders that you're seeing are actually going up again. And so that's another tailwind within these exogenous variables that are not necessarily favorable, but it's enough to keep you along these stocks to make it not worth your while to be jumping in and out of this space in particular situations. And it's, if you have that bail, if you're a market share taker right now, you don't necessarily need to bail the way you would in a situation where the Fed isn't necessarily on your side and inflation's not working for you as an investor right now. Typically, that's a get the hell out of Dodge signal for a lot of the names in the consumer space. Right now, you can make the case in very select situations. We talked about cost before. I'm long cost and Target. I kind of turn the dial on which one I want to be long more of. I'm also long Walmart. But if we drew a Venn diagram of customers for those three companies, it's much closer to just a circle. Just they're all the same customer than either of them would like you to believe. There's a perception Walmart's super low end, Costco's kind of the clubby people, and Target appeals to yuppies. They're all going after the same customer. It's just a mix of who's been hot and who's been not. Target's been kind of losing share. They took their eye off the ball for a couple of years, but they've got a lot more upside operationally. And so data to answer kind of what you're talking about before, I don't know what cost can do to improve because they've done so many things exceptionally well, but I can think of a whole list of stuff that Target can do that's going to move the needle for them right now. They can do a better job on their private label. They're getting rid of self-checks in favor of the actual cashiers. Those are great catalysts on the margin for Target. And that makes me want to be long them. It's much cheaper stock right now. And it's a way that you can still be long and be exposed to equity. So you're not just diving out of the market and trying to make this huge macro timing call that I'm sure you see if you're investment advising people, that everyone wants to make a call. Everyone wants to call the bottom, call the top, and they just incur fees and taxes like crazy. You can tweak your portfolio, turn the dial a little bit between some of the brands.
I do know some people that do tweak their portfolios, and I never understand why they do that. So when you're talking about the consumer, you're talking about the economy, you also have to be thinking about housing, right? What are your thoughts around housing? Because surprisingly, it seems to be picking up, right? So doesn't that signal that the consumer, at least they think they're in a good place? Even though I know that there are also some inventory.
Yeah, there's so much noise. Dan, we have just spent the last kind of 4 or 5 years, ever since we did the big grand experiment of let's shut down the economy to an absolute screeching halt and then throw cash at it to restart it. the echoes of that are just rippling so hard that it screwed up some of the indicators. What's going on with housing right now? Jeez, you can come up with all kinds of theories on it. It's really hard to move. It's really hard. It's just, if you're locked in at 3%, just choose to sit where you are, just squat, and that explains it. That seems to be kind of the Occam's razor of what's, how is housing kind of picking up? Well, it's just very hard to move. And so the only people who are moving are people who can either really afford it or really have to. That, we've pent up that demand long enough that you're seeing kind of upticks. Is that artificial, or is it just an echo of post-COVID policies? I'm not really sure. I don't trust all the tells that I used to trust as much as I did, because there's just so many cross currents and there's so much unwinding of all this stimulus that we've had going on all at the same time. And so I think part of what you're seeing is just the pent up lack of housing transactions that we've seen for so long. And now it's just push comes to shove. There are certain times in your life when you got to move, and you become a little less price sensitive than you want to be, but everyone else is stand pat. And so there's some questions as to what inventory is coming on board and how much liquidity really is having an impact.
Yeah, I mean, economic disruption will cause people to have to move for unfavorable reasons on a timetable that might not work from an investment perspective. But outside of that, obviously, the ability to move is good for an efficient economy, right? But what we're seeing now is, a lot of realtors we're pushing the phrase buy the house, rent the mortgage, right? Or rent the rate. And you're going to be dating that rate for much longer than you expected now. I mean, the 30-year rates on mortgages are back in the sevens, like I think mid sevens right now. But you're seeing new home starts decrease because they're feeling the effects of inflation as well. So you have this supply suck that continues to go further and further down. Are you anticipating a balance in maybe some of these home improvement stocks? Is Home Depot going to perform well? What are your thoughts on that? Is that going to be a source of growth? Just because those companies have been a little bit dormant as well. So
they've been really dormant, and you're not seeing anything that would just make you think that they're coming back anytime soon. I would think that in theory that should work for Home Depot, and you can kind of show up quarterly and you look through the company, you talk to management, you listen to management. They're still really well run. There's nothing particularly wrong with Home Depot other than the environment that Home Depot is doing business in. And it's been a while since they've kind of caught a tailwind in terms of the lumber prices. Well, those have gone down and now rates are going back up. And so you have this kind of, it's just been frozen. Home Depot doesn't win either way. It's been either too expensive or almost you can't give it away in terms of your supplies. Right now, we haven't seen that bounce that you would expect from the Home Depot and the Lowe's of the world, and they're not expecting it to come back anytime soon either. So, it's with the company as large as they are, and you're seeing really kind of virtual monopolies. Home Depot and Lowe's are just splitting up the world and letting the smaller guys just have their bits and pieces. They are going to turn more like aircraft carriers than they are speedboats. You're going to have a couple quarters to catch Home Depot when you want to catch it. In the meantime, you're better off just kind of waiting for the turn and just looking for them rather than this kind of theoretical turn that should be happening. Wait for them to actually tell you what's going on. I trust their management directly more than I do the would-be catalysts, because they just haven't been coming together yet.
So, Jeff, I mean, we're mostly talking wealthy when we're thinking about the consumer, at least in the context of this discussion. What do you think, the wealth effect is with interest rates just on CDs at 5%, having to the equity markets right now? I mean, I'm sure most people are saying, listen, I'm sitting 10% cash and it feels pretty good, right? What is going to be the incentive for them to take the risk to invest there? If you want to focus on consumer stocks, that's fine, but more money in the equity market.
Sure, time and price, right? I mean, it's. I feel comfy with my cash, and I feel kind of confident that I'm gonna feel even more comfy with it. because it's this competing asset, and not everything in finance is broken. If you're going to give me risk-free money at a nice rate, I feel pretty good about both sides of that, about reducing my risk and getting my cash. It helps me kind of keep up with the ridiculous gas. I'm comfortable in cash right now. So what's it going to take? Well, it's going to take either a big substantial break in price, which frankly it doesn't seem like we necessarily have this air pocket risk that we did. We have the need to spend a little time churning and burning. And in my space, I look at the consumer stocks, they're a lot of canary in the coal mine kind of factor. And you can see when sentiment turns just a little bit, the impact that they have on something like, say, the Gap. We mentioned them before. That was a $28 stock before they reported. They were just fine. The initial reaction to those earnings were, hey, not so bad. They're righting the ship. Well, now it's a $21 stock. So here's your 30% haircut. You better love Gap if you're going to withstand a 30% haircut on really anything. What keeps you, it's what's going to get people out of your 5% money and into a stock like that. Maybe just letting the stock park for a little bit, maybe let it kind of burn off some of that excess optimism we had, because a year ago it was an $11 stock. And so you can picture that, it trebled and then has gone down by a third. That doesn't make it a screaming buy. It makes it kind of a lousy short, and it doesn't make you want to come off the sideline. Sometimes it's just that easy. Sometimes in terms of, let's not overthink this, shall we? If you're going to be talking to a client and say, listen, it was 29, but now it's 21. They're going to turn around and say a year ago it was 11. And, you end up on the bench still sitting in your cash.
Yeah, Jeff. So before Dave just mentioned something short, right? Talk to us a little bit about, if you're willing, like what ideas are worthwhile looking on the short side, because we always think about the long side. We always talk about the long side, but the short side, I think, often could be smarter.
It can be, and I'm not adverse to it right now, but again, that speaks to the speed with which we've seen a decline, particularly in my space. When stocks in general are going down, it seems like every single day in April. I'm sure that's not right, but boy, it certainly feels like it. It feels like we're pulling about it over 18 in April to date anyway. It's going to really decimate these higher vol type of stocks. I think the short side is a little bit played out. I don't feel like they hit the wall. People are short Netflix going into this. If you wanted to be aggressive, it's tripled. It's done this and that and the other thing. You end up with 3% returns. Lululemon would be one that I know a lot of people were short on that. It's down 30 or 40%. Is there more there? Maybe. But man, the worm turned so fast. And in this type of environment where there's a lot of people really pretty skeptical, these shorts get crowded, and it becomes something that I'm not morally opposed to shorting, or I think that shorts provide a exquisite value to the market, but I just don't see a ton of blanket shorts out there that I want to be betting on. And the ones I do, you either can't borrow the stock, or there's just, they make it so onerous in terms of what they're charging. Give you an example. It's Rent the Runway. Just had a huge run. It went up, fivefold in like 2 days. It kind of on the idea that AI was going to fix them and they weren't going to go out of business. My DMs start lighting up with the idea of it shorting it. You got to take the other side of this. Got to take the other side of it. Well, A, you can't find a borrow. B, they're going to charge you roughly infinity. It's what's it cost me to borrow this? Well, freaking 50% a day. Loan shark money, and we're sending a guy veto over your house to collect the rate. So it better go down right away immediately. You get to tell people you were right and make no cash.
What about a company like Pinduoduo with Temu, right? So I think this is very kind of interesting for how some of these at-scale retailers in the U.S. deal with a truly, even if there's like reason, even if we're kind of deglobalizing the markets in certain cases where still like, you can get glasses on Temu for $3.85, right? How does a company like Warby Parker, which is supposed to be the cheap offering, kind of really compete like that? Amazon no longer becomes like the cheapest offering. It's just the on-demand 24-hour turnaround offering, right? The cheapest offering is like actually buying something on a platform like Temu and waiting 3 weeks now. So I feel like there's this new tier of cheap that just comes with like 3-week delivery in our world. And I think that's a category that's just going to grow more and more and more. I think there's probably more people in your world than you would realize aware of platforms like Temu, at least in the last couple months. So how does that reflect on Amazon? How does that reflect on other categories, Warby Parker, whatever you want to touch on in that space? So
Amazon's interesting, and they're probably our best example because of some of the specifics for what they're being sued for right now. Amazon's the biggest clearinghouse of sketchy-ish merchandise that you're going to find really extant in the United States. Their third-party sales business is already bigger than Target. So it's enormous kind of a flea market aspect, whether or not they're particularly vetting all the shops that are doing business online there is a question open to debate. The answer is not really, but can't legally say that. But the point is, Amazon is being charged with forcing their third-party vendors to actually charge more. So they're keeping the prices artificially high. It's a dial that Amazon can adjust internally. In other words, there's a lot more room for them to go cheaper if they needed to, if they felt like there was that demand. But it's worth it to them to protect their margins for both their kind of legit vendors and the less low-scale, cheaper ones, and give that same-day delivery. And so you're going to need kind of perhaps a worse economy to really have those ideas start taking traction. I agree. They're going to continue growing, but it's got to be that 3-week delivery that's going to be what is really that crack. That's really going to be the thing that needs to change to lessen that gap with Amazon. Amazon has such a huge moat with the delivery function that they have now, with the speed that they're able to do it, and with the way they're able to kind of blur the lines of those vendors, that the guys that are able to sell glasses for $3 are going to do it on Amazon simply because they can charge, and indeed are forced to charge, higher margins than they would on the Temus of the world. And, it's worth it to the consumers. We've gotten really used to getting stuff very fast. It's the old joke about Wi-Fi on a plane. It's a freaking miracle that you can get Wi-Fi on a plane, and after an hour of it, the first thing you can do is just bitch about how slow your Wi-Fi on a plane is. It's a miracle. It's fantastic that we can get things online. Holy crap, the bargains that we're able to find, but we still demand it in 2 to 3 days, or we just start losing our minds over how slow and inefficient it is. So, there's a little bit of a reliability factor. You're right. There's that the rock bottom prices, Warby Parker aren't going to be able to compete with that unless they figure out kind of their edge. But in the meantime, Warby Parker wasn't that great at business to begin with, but Amazon, on the other hand, is making a ton of money with the ability to go for lower prices if they need to, but the consumers aren't telling them that they have to. And the way for them to optimize their returns is still charge more with the convenience factor versus just charging rock bottom prices and slowing down the delivery.
And I feel like we're going around the world, or at least around the U.S., with Jeff Macke on just picking your brain. We appreciate the time. So what about cars, car dealerships particularly, like AutoNation? You have any thoughts, on that space? Because that definitely is going to be consumer sensitive.
You would think. My biggest thought is, damn it, I missed Carvana. It should have bought that in the single digits when everybody was giving them up for dead. That would have been a great idea. But again, it's kind of a tapped out market from my perspective. It's AutoNation would have been a short. That stock has been absolutely smoked over the last few days. It didn't seem that bad to me, but there's so many different factors that go into it right now. It's when you have the EVs falling apart in terms of just as demand goes, the hybrids getting favorable, and cars lasting longer. I just kind of avoid the space, and to me, it's just it's still going to be just a levered function where you get back into housing, get back into kind of these big semi-discretionary purchases that people are making, and I want to make bets on those type of spaces really at more extreme points in the economic cycle, as opposed to this kind of muddling along area where we seem to be stuck now.
Yeah, that's where the hybrid car is really what's done well in that space, right? Toyota's really separated themselves from the pack by just focusing on hybrids over direct EV. And then in the direct EV, I'm going to kind of go back to the whole China-US story, is like, that's where China's like, oh, you want the actual cheap $10,000 to $15,000 car, like you have to get it from China outside of tariffs coming from the US, doubling that price for US consumers. Like, those cars, outside of that, those cars will be on our roads at some point sooner rather than later.
And here they come, right? I mean, absolutely, here they come. How much are the tariffs going to be? What's the markup going to be between the 10 and 15 and what we end up paying for it in the States? I'm not sure, but it's going to cost less than the EV players now, and it's got, you can't really be what still is a capitalist society, as much as we like to kind of bitch about the way we execute it on the fringes. But ultimately, a cheaper product that people want is going to find its way into the United States. It's just going to be a matter of the specifics, and that's going to be kind of the pressure on the Teslas of the world. I've got no take. I might be the one fund manager in the world that has no long or short take at all on Tesla. They seem fine to me. I just think that here comes a huge wave of competition, and it's arriving at the exact same time when there's evidence that the pure EV market has kind of maybe hit a little bit of an impasse, and the hybrid model is going to be more logical, both in terms of the environment and the ostensible reason that this entire space exists in the first place, and for what people, how they want to use it, what becomes practical. Range anxiety is still a real thing. Will they solve that problem? Probably, but by the time they solve it, the Chinese cars will be here for $22,000, and it'll be a whole different ballgame.
Right. It'll be interesting, right? You talked about the consumer wanting this in 24 hours over 3 weeks. How much do people value? Obviously, if you have an electric plug in your house and you're fortunate enough to have your own garage and you can kind of charge it at home, that's one thing. But how much otherwise do you value 8-10 hours of your life sitting at an electric pump, especially in metro areas where, like, if you're coming from certain directions, you might not actually have that many options, and you can get backlogged. There's stories of Uber drivers waiting for 8 to 10 hours just to get a charge. So it'll be interesting to see where that adoption actually goes and what that does to something like Tesla. A smart man once told me that, not that I'm recommending Tesla at all whatsoever. I actually am quite bearish on it at this moment, but not to be bullish on Tesla until Elon refigures out his new options package. So first his old one and now his new one. And then once he strikes a low price for his new options package, then he'll start saying things the market likes, right? That's when the good stories come out. So,
and from a practicality perspective, it's the range anxiety thing is real if you want to take it away from your house. It's ultimately you want a car to do a family road trip on. It doesn't matter kind of where you are economically. It just, you guys are males. I don't know how you roll, but when I'm on a road trip, daddy's driving, and I don't want to stop for 45 minutes to reboot up my car. I just want to fill it with gas and keep going. And you kind of can't do that yet. And so you're at this awkward space in terms of the evolution of this, EVs as a whole, where you've gotten the first adopters. We've really eaten into those people who are just all gung-ho on taking it. And now we're at this kind of dead space where the infrastructure isn't quite done yet. We've got lower price models that are going to be here soon. And these items don't really satisfy that sense of American urgency of let's have it now, let's have it faster, let's have it yesterday, that we really have kind of grown to demand in our hyper-impatient society. Best in the world, a little impatient. So yeah, I think you're exactly right. It figures to be a little lull in that evolution.
Going back around the consumer and the health of the consumer, we don't talk so much about unemployment anymore, right? We're like in a good position with employment, but we've seen some layoffs of late, right? What is your thinking around unemployment? I know you're not an economist, right? But you still have to be thinking about the consumer unemployment by end of the year, right?
I'm a California consumer who has friends, and in fact, a family that I work with who owns McDonald's, literally like the chains. $20, it's paying people $20 to ring a register at McDonald's does not make any economic sense whatsoever. It just doesn't. It's the stores aren't designed to do that. And so you go to this kind of drive-through, almost an asset-light kitchen model with as few employees as you can. Unemployment right now, we are in a good place employment-wise. And so what we're doing about that is kind of the best we can to kill it. And so now, the people that I know that are running their McDonald's, doing a great job, but they can't afford the employees. And it's not because they're Scrooge McDuck. It's because it just doesn't make sense. These were never jobs that were intended to be careers. we've inflated the cost of hiring people for what amount to startup jobs to the point that they no longer make economic sense. Now that's got to speed the adoption of technologies that take care of that, but it's going to eat into the margins of McDonald's, both as a chain and as a corporation. So whether you're running them or whether you're the corporate parent, it's just, you got to rethink your economic model. And so I think, employment right now, it's better than it would figure to be. We seem to have a pretty good handle on it right now. It's the data keeps coming in a little too hot if you're in the camp that you want the Fed on your side. And that's just one of the cross currents that we have. That's a little bit of a conundrum. And it's a little bit of a fly in the ointment on the whole low-end consumers falling apart thing, because folks are still hiring. It's if you want a job, there are jobs available. That's not always the case in this country, but it is now.
My understanding was actually JOLTS was falling a little bit, but I actually think the last 12 months of employment data is going to be something that's going to be studied for a very long time, because there's like two diverging camps in the economist world right now. So the big phenomenon that no one can really explain right now is the flattening or even dropping of full-time employment and the rise of part-time employment. So there's like the rosy side of it of this is by choice. This is free retirement, partial employment, spending more time how you want to in your career, or this is by necessity, need, whether it be a second job or lack of options for a first job, or as some people have pointed out, Uber being the first line of defense before unemployment, because unemployment payouts are just so low you can't even consider living off of them. And I also think the denominator is in question, quite frankly, with just how many people we have in this country. So I think that I'd be curious what's camp you falling in terms of is this massive rise in part-time employment. The benefits of our evolving society and choice of people who get to make that choice, or is this by need and second jobs and things of that sort, or lack?
I think we need new measures. I think you could also fold into the things that might be temporary camp, work from home. That to me is probably got the most ripples coming off it in terms of something that's changed over the last 5 years that's kind of unknowable. When you just look at the economics of, okay, what's it really cost me to spend an hour each way going to work? No one's going to do that 5 days a week anymore. How many people are going to do it? I'm not sure, but that changes. Take a company like Sweetgreens. Take, anyone in the pipeline of I used to live in New York. You get on the train, you spend X amount of minutes on the train, you get off, you're constantly consuming. You're buying a Starbucks, you're buying a bagel, you're buying whatever. All these expenditures that you don't make if you're working from home. That has been a huge kind of cost saver on the margins for people. And that causes a few different things. One, reluctance to take full-time jobs where you're not just working from home. That improves sort of the economic view of both side hustles and voluntary part-time employment. And two, the economics of everything involved with the commute. So that brings us into cars, that brings us into housing, that brings us into Home Depot, that brings us into all these different kind of players that you wouldn't necessarily think of, that wouldn't be absolutely obvious. Dress shirts, it's formal suits, anything that you would wear in a conventional office setting. Where does that kind of steady out? Well, I'm not sure, because it's anecdotally and in economic reality, and just kind of look around, we don't know what it's going to end up looking like right now. As much as corporations would like to have people in 5 days a week, that doesn't make sense for a lot of different people. And Americans, being sort of flexible thinkers, and figured out a way to find jobs where they don't have to. And so that muddles the employment picture and economics all the way up and down that huge commuting pipeline that's been almost regrettably large portion of the American economic picture for, since the industrialization, since the post-World War II invention of the freaking office spaces, horrible industrialized kind of white-collar job situation. Well, clearly that needed some fixing. I'm not sure where it shakes out at the end, which makes it a questionable bet for me. We need new indicators, and that's what I think people are going to be talking about 10 years from now, is how we really gauge employment. What's that really supposed to look like? Yeah, we think we have a hard time gauging inflation correctly. man, you get into kind of the secondary derivative type of indicators, and it's almost impossible to come up with something, not that you could fit a theory on, but that you'd actually want to place a monetary bet on.
So we're approaching the end of the show. I have one or two more questions. Obviously, if there's anything you want to highlight on before the show ends, please feel free to do so. I want to ask about the fast food category that we touched on a little bit earlier before. It's like, at what point can they just not compete because of the price? And obviously, just not the labor, just the input costs, like you're seeing it in states outside of California as well. The $20 to $22 fast food meal kind of loses its hope benefit to at least being the cheaper option. America's been unhealthy partially because that's been the cheapest option, but that may no longer be the case. We talked briefly about Gen Z shopping in supermarkets in numbers we've never seen, right? People are cooking at home a lot more. But when the cost benefit of fast food erodes, outside of maybe something like Chipotle and some others that have done a decent job, like, where do these companies go?
That's where kind of automation and what AI is really going to do is going to start getting an actual hold on the economy. And that's going to be the solution for a lot of these fast food places, because they're very conscious of the fact that prices have gone up. Yeah, it's not like McDonald's isn't aware of the fact that it's pricier now to get a meal there than they would like it to be and than it was a year ago. They're going to figure out ways to drive that down. They can't change the fact that it's going to cost $20 an hour to pay someone in California. That can change the fact that maybe you don't pay them. And so, it's when you do the drive-through window, well, AI can do that better.
So are they going to lower their prices or stop raising their prices?
They'll stop raising their prices as they control their expenses. They'll control their expenses by employing few people. What's that do to our employment picture? We're going to have to see, because, you need to, we've never kind of tweaked as aggressively those low-end jobs as hard as we're doing it right now. Minimum wage has been woefully under what any type of living wage would be forever. Once you actually mandate it, where just even start employing people again is $20 an hour. We got to see where that kind of comes into play. California will be the test case for that, unfortunately. And so we'll see what happens. My bet is that the economics of it will demand technological innovation, which frankly, there is some room for that. That's going to be the where the rubber hits the road on a lot of this AI that has been fueling the bubble for the last year. In fact, saved the markets a year ago at this time. All of a sudden, AI swept in out of nowhere, became the next big thing, and we all forgot about regional banks going out of business. Well, how that's really going to look is much less glamorous than replacing every job on earth. It's going to replace some of those jobs that, it's no one really wants to talk to the call centers. If you can make a Siri that actually works, that actually can answer my questions in a reasonable way, and isn't just trying to simulate a conversation, isn't someone in India that's been outsourced, but is actual intelligent, able to answer the questions just through what amounts to long-form algebraic equations. That's going to be how you cut back the expenses. And that's obviously going to lead to fewer entry-level jobs. They're not the sexy, hot jobs. I'm not calling for AI to put people out of work forever. I'm saying that, it's not going to impact the high-end consultants quite the way that people think, as much as it is just going to get rid of all the people that would want an entry-level job, just for the experience of it, for the traditional American reasons of, I took my first job at McDonald's. I learned I don't want to work at McDonald's every day in my life because it's really hard to get yelled at by customers about the fries all the time. Well, those jobs go away now. Is that good or bad? Well, I think it's a terrible thing. I think that's a great way to learn, to be introduced to work. But, what's it do to the inflation rate? We're going to have to see. And that's going to be really, we use the expression, kind of turn the dial a little bit a number of times. But that's another one where there's the governmental pressure to kind of make it seem like it was supposed to be a career to serve Big Macs, versus the economic reality of that job can be replaced. It's just a matter of how much it's going to save me versus how much it costs to install it. Well, the cost to install technology is going down. The cost of employing the alternative labor is going much higher really fast. So something's got to give, and it's going to be fewer jobs.
You should start an AMI call center and call it representative.
And just get my order right in the drive-through. It's what you can do that's going to be, think of the complaints that takes out of it. Think of the tension it takes out of it, the jobs that are really not that attractive and that you can't afford to hire someone to do anyway. All that gets solved by really a practical application of this tech that no one can stop talking about because it's going to be the end of the world. It is much more likely to be the end of unsatisfactory drive-through McDonald's experiences than it is anything else.
So yeah, we covered so much, and you didn't know this, but they spent a fair amount of time studying the restaurant industry, and David also is an expert on gig economy. So you touched on a lot of things that are true to our heart. I do have a random question behind you. Are some dog things, right?
My dog things, yes. My
yeah,
dog and my
dog
Labrador.
Dog people are great people. What's the story behind that?
Those were gifts from my mother years ago. She had custom paper mache dog clocks made, and they were the nicest way to mount my beloved dog's head on my wall without actually having to do any taxidermal work. They just sort of, decorations. I've got a bobblehead of me back there someplace next to a bobblehead of Tiger Woods. You live long enough and are public figure long enough, you kind of collect a nice amount of tchotchkes. So it's I've got a decent array of little stuff that someday I'll pass on to my kids. They'll throw it immediately in the trash.
Like you're going to say, live long enough to become a bobblehead.
I achieved a bobblehead dome a long time. It was a while ago, But yeah, that's where do you go from there? Yes, nowhere fast, but also it's been a pretty good ride, and I get to talk to you, lovely people, with my bobblehead right behind me.
I told you we were more fun than Godhead, so.
And you're right. Yeah, it's been a delight, and I hope I didn't screw up the restaurant thesis too bad for you. I had no idea I was talking to experts.
Well, no, not at all. No, this has been great. Thank you very much. Is there anything that you want to conclude with as to, how people can find out more about what you do?
Just check out Wall Street Beats. We have a pretty good roundtable function literally every morning. You get the discount, lead lag 25 this week. And I think that you really want to hear as many differing opinions on a lot of different stocks as you can handle. The number one trap in finance is just falling in love with your own big brain and your own ideas. Stand up to the criticism, listen to different takes, different themes, different ideas, because there's a lot of different ways to look at it, and you need to find the strategy that fits individual investors. And so if not my service, listen to you guys, just collect as much information as you can. When I talk to kids about investing, that's always my advice to them. They want to know what the magic bullet is. And the answer is try to read a little bit of everything and always understand what the guy on the other side of your trade is thinking, because the chances that everyone's wrong except you when you're trying to buy a value name, in my experience, it's pretty low. There's usually a pretty good argument against any idea I have.
Thanks very much, Jeff. David, it's been a lot of fun. See you around. Just in general, look forward to hearing more of your insights.
Absolutely. Thanks a lot, guys. It's been a pleasure.
Thank you so much.